Hello, everyone. Welcome to our webinar on investing in uranium exploration and development in Canada. This webinar is really prompted by a number of things, and I'm sure everyone's been watching the headlines, but the key theme that I keep coming back to is that the uranium bull market, the next big bull market in uranium, has been inevitable for some time. In fact, at my New Orleans conference every year at a mining share panel, virtually all of the participants have said that uranium is their highest conviction story. And this will be the year for the big uranium bull run. And we've been saying that for the last 10 years or so, and it hasn't happened. But this inevitable bull market now appears imminent. All of the forces are coming into play at one point in time, and it really seems like we are on the cusp, and the price trends actually confirm this. We are actually beginning a new run in uranium. And there's really three big trends that are doing this. There's electrification. That's the big, huge demand trend. We need power. We don't have the current power necessary for the electrification of the world, particularly transportation and the new energy grids that will be necessary. So nuclear is necessary. Decarbonization, the whole climate change thing, nuclear is the green energy, the only real baseload green energy out there, and that's becoming more and more recognized, and we'll get into that. And the big thing now that's helping to make everything imminent is energy security. We've seen that just today as we speak with Russian missiles landing in Poland, and the Russia's weaponization of energy commodities over the past year has really highlighted a lot of the mistakes that countries have made over the past 10 years or so in moving away from nuclear. And in fact, they've reconfirmed that. We saw in July of this year that the EU Parliament has confirmed or anointed nuclear as a green energy source for the first time. And the UK is moving to upgrade its nuclear fleet. Of course, China is continuing along that path. India is as well. And even in the US, we've seen moves toward the resurrection of nuclear plants. So all of this is coming to a head right now, and the world is beginning to recognize nuclear as not only a green energy and perhaps the best green energy source, but really as the only reliable baseload energy source going forward, and the most affordable. And what we've seen is that after decades of constrained production and now ever-growing supplies, we currently have a supply gap, and that supply gap is set to expand dramatically in the years just ahead. So all of that is what comes together to kind of prompt this webinar. And I think it's a very important timing for it, but also very important in that we brought together three of the preeminent companies exploring for uranium in Canada and in North America. We have Skyharbour Resources here, which is one of the leading, if not the leading, Athabasca Basin exploration stories, notably holding 100% of the high-grade Moore project, and has a hybrid model for exploring Athabasca, as we'll get into in a little bit. We have ValOre Metals, which is, interestingly, two companies in one, kind of a bifurcated company with not only great uranium assets, but also PGM assets, and a company that is, by my measures at least, dramatically undervalued by either one of those assets that drive the company right now. And we have Uranium Energy Corporation, which is, I believe everyone will recognize, the blue chip uranium growth story out there in the sector today, with some really extremely high profile acquisitions over the last year. And we'll get into those a little bit as we go on. But first and foremost, we will examine the market for uranium today, how it affects not only these three companies, but the world at large, and the opportunities it offers for investors. Before we get into that and some of the bigger issues, I would like to go to each of our panelists here and get kind of an elevator pitch, perhaps an elevator pitch in a tall building for each company. Just give us a quick overview, guys, of of what makes your company unique and what is your niche in the exploration sector. Let's start off with Jordan Trimble, CEO of Skyharbour Resources.
Great, thanks, Brian, and thanks everyone for tuning in. It's great to be on here. I think it's a very timely webinar. You hit on some main points there, and we'll get into some more of the macro discussion, some of these recent developments. We are a high-grade uranium exploration and early-stage development company, all focused in the Athabasca Basin currently. We've been around for almost 10 years, so we were there through the thin years, the difficult years. That was really the contrarian opportunity to build the asset base that you see in the company currently. We're now one of the largest landholders in terms of mineral claims in northern Saskatchewan in the Athabasca Basin region, which is the highest grade depository of uranium in the world. Long history of mineral exploration, development, and production in this region, but we've got 1.1 million acres across 15 projects. These projects range from earlier stage exploration properties right through to more advanced stage exploration assets that do host deposits and high-grade uranium and historical drill holes. They're highly prospective for additional discoveries and resource expansion. You mentioned, and actually if we want to just go to slide 3 here on the deck, that would be great, just to show everyone the portfolio of projects that we've amassed here. If you can get there. Oh no, okay. Well, I'll just continue on then. So the 15 projects, as I mentioned, we have a hybrid model, as you pointed out, Brian, and what that really is we've got high grade. We offer investors high grade discovery potential and exploration at our core or primary projects. Those 2 projects are Moore Lake, which we acquired from Denison back in 2016. We own 100% of it. It's an advanced stage exploration project on the eastern side of the basin. Denison has continued to be a strategic partner and large shareholder in Skyharbour for the last 5.5, 6 years. Here we go. And then the other project, more recently, more topical for our company and our shareholders, is the recently optioned, you'll see here, Russell Lake project, which we've optioned from Rio Tinto, bringing in Rio as a large strategic shareholder and partner as well. This project, very, very strategic location between the McArthur River Mine, the Key Lake Mill, one of only 2 operating mills in the Athabasca Basin, our Moore Lake project adjacent to the east, and Denison's Wheeler River project to the west. It's road accessible. The road that services the McArthur River Mine runs through it. There's power, and it also comes with a 40-person exploration camp. So we'll be actively advancing and drilling these projects, generating lots of catalysts for shareholders in the coming 12 months. Be our biggest and busiest drill season and drill campaign yet, with 10,000 meters fully funded. But we also have a dozen or so other projects, secondary and tertiary properties that we've acquired over the years. And this is a part of our prospect generator business. So we've now brought in 7 partner companies over the last several years, 2 of which are JVs, and 5 of which are still actively earning in. And you'll see that at the legend at the top of the screen there, the various partner companies. Well, these partner companies are funding the exploration and paying us cash in stock. We've actually now signed over $70 million in exploration expenditure commitments and cash and share payments coming in from these partner companies. So it's a great complement to our primary business of making new high-grade discoveries at our primary projects. We're looking at a combined drill campaign between us and our partner companies, somewhere between 30 to 40,000 meters over the next 12 months. So very, very busy upcoming year for Skyharbour and our shareholders.
Thanks, Jordan. Again, very, very active on the uranium exploration front. We'll get into some more detail as we go along. Next, we have ValOre Metals Corp with Jim Paterson, CEO. Jim, tell us about this dual company that you have, right, and opportunity that you have here for investors.
Great. Thanks, Brian. Thanks to the panel and all the web visitors. Grace, maybe just take it right to slide 2 so we can talk about that bifurcated company as Brian describes it. ValOre trades on the venture exchange. Market cap is roughly 50 million. We have a uranium asset and a palladium asset. We're a proud member of a group called Discovery Group, and Discovery Group has had a lot of success over the last more than a decade now, all in the mineral exploration and mining space. And ValOre is a proud member of Discovery, and we leverage the power of the group to attract people, attract capital, and succeed from a discovery perspective. The bifurcation here would be the two projects, two different commodities, and also two different continents. So we have our Brazilian asset, which is called Pedra Branca Palladium Platinum Project in northeastern Brazil. There's a resource defined there, significant money spent by previous operators. After we picked up the project, we doubled the resource from a little over 1 million ounces to 2. But prior to that, we had been kind of a star in the uranium business, in the uranium sector in Canada, and have a project called Angalac. And in the last cycle, we were very active advancing that project. And you can go to the next slide now, Grace. The Angalac property is one which is actually something that was kind of under the radar over the last few years because we were advancing our Brazilian asset. But it is a large land package, almost 60,000 hectares. We have one of the highest grade uranium resources on the planet, excluding the Athabasca deposits that Jordan so appropriate or aptly described it as the high grade repository of the world, which is very true. But outside the Athabasca, we actually have the highest grade resource of scale on a global basis, 43 million pounds at 0.69%. We spent over 55 million on that project as a company called Kivalliq Energy. We renamed, rolled the company back, and then this past season we've been very active. We put some news out today with some high grade uranium on one of the targets in the project. Would you be able to take it to the next slide? I'll just show you kind of where the project is. Okay, so as it's getting pulled up, it is in southern Nunavut, large land package. Like the Athabasca, it is on a basin, a sandstone basin, and we actually control the northern portion, the northern half of a sandstone basin called the Anjikuni. There's the expenditures right now, and we have a resource. And what's really exciting is not only is the resource open for expansion significantly, but property-wide, we have drill holes that suggest that we have mirror systems almost 25 kilometers away that could be as big or bigger than the current area that hosts the 43 million pounds. Thank you.
Thank you, Jim. And now we turn to Uranium Energy Corporation and its CEO, Amir Adnani. Amir, I remember years ago meeting for breakfast at the Royal York at the PDAC conference, and you told me you're about to start a uranium company. To paraphrase the old commercial, you've come a long way, baby.
I have a very clear memory of that meeting, Brian. It was so cold outside that I think that the backdrop of the ridiculously cold weather of Toronto in March for PDAC has etched the memory of that meeting in my mind forever. I think I walked out of the hotel room and thought my ears are gonna fall off if I just walk from this hotel to the next to come meet you. But anyways, it's been an interesting 18-year journey. I think when I first got in the uranium business, I was told in commodity cycles we typically see, 2 good years for every 3 bad years. I'm approaching 19 years in the uranium business, and we've had cumulative 3 good years and 16 really bad years. And so it's just quite an unusual industry to have been in. And real kudos to Jordan and Jim, who are truly kind of in that rare breed of entrepreneurs that have actually survived this unusually long nuclear winter that we've had. And of course, now things are turning a lot better, And so a few kind of fundamental themes run through the strategic thinking behind uranium energy from day one all the way up to the last 12 months. And that fundamental thinking and belief is that there has to be, we believe fundamentally, there must be a shift away from Russian supplies of uranium. We believe that Western governments, Western utilities are in fact very much trying to diversify away from Russian uranium and former Soviet Union states. Today's very unfortunate event, as we entered this webinar, there's breaking news, as Brian, you touched on, about these Russian missile strikes into a NATO member, Poland. It's ugly. What's been going on in Ukraine is ugly. and it really has long-term ramifications for where we get our supplies of uranium and other energy commodities from. I cannot think of more geopolitically stable, mining-friendly jurisdictions than places like Texas, Wyoming, and of course today we're talking about Canada, and we do in fact believe in Canada's future in the mix for geopolitically stable resources, and that's why, as part of our acquisition strategy over the last 12 months, we've made 2 acquisitions with UEC in Canada that positions UEC with the 3rd largest diversified resource base in Canada after Cameco and Orano. So we've really believed that not only is this an excellent time to buy assets, but the reality is that uranium prices at these levels are simply not incentivizing new production. No one's building a brand new uranium mine at $50 uranium. That's a fact. And so where uranium prices need to go to is somewhere north of their 2011 peak of $70. We're not there yet. And that's before we adjust for inflation. So in that context, we think this is a great time to buy. We've spent $570 million making 3 acquisitions the last 12 months. We acquired from Russia's Rosatom Uranium 1, and we repatriated those assets into the hands of a US company. We've then turned our attention to Canada. We got into a bit of a tussle with another uranium company over UEX, successfully closed that acquisition, and then followed that up with the acquisition of Rio Tinto's Rough Rider and welcomed Rio Tinto as a 5% shareholder of UEC. That takes UEC's total resources to 354 million pounds across all categories, 245 million M&I, and 109 million inferred. For a diversified resource base, that in fact is the largest in North America, the largest in the US for fully permitted, and then in Canada exclusively would be 3rd largest after Cameco and Orano. So we've managed to triple the size of our resource base, double the size of our production capacity. We have a licensed production profile in the US of 6.5 million pounds, 93 million of cash liquid assets, no debt, and a physical inventory program where we've purchased uranium at $37 per pound under long-term contracts, kind of the opposite of what Cameco has done, which is to sell uranium under long-term contracts at above $40 per pound. So this conversation is about Canada and Canadian assets. You got the east side of the Athabasca Basin, the west side of the Athabasca Basin. For anyone who's on this webinar that has never heard of Athabasca Basin is to the uranium industry globally what the Persian Gulf is to the oil and gas industry. It's where the richest grade deposits are. It's where some of the biggest resources are. And it's a province that truly has a regime from a jurisdiction and a permitting point of view to govern uranium mining. These are really important attributes. When we look at the Fraser Survey Institute for Mining, who's number 1? Quebec in Canada. Quebec has a ban on uranium mining. Who's top 10 in Canada? British Columbia. We have a ban on uranium mining. There aren't too many jurisdictions you can go and mine uranium. So to have geologically unusually high-grade deposits in Athabasca, but also a province that truly supports this industry and has for many decades is a very rare combination. So on the east side of the basin, we've taken possession of, again, Rough Rider. That was a $150 million acquisition from Rio Tinto. That's an asset that Cameco coveted and got into a bidding war over Rio Tinto over in 2012. And we've combined that with the UEX portfolio, including the Christie Lake project, 80% owned by us, 20% owned by Denison, wedged between Cigar Lake and McArthur River. And in fact, we hit the ground running in Athabasca. We announced the best drill hole that's been intercepted this year in Canada in Athabasca. It was 2 meters of 68% uranium. Brian, say it with me, 2 meters of 68% uranium. So this stuff is, but this is why you want to be in Athabasca Basin. And so our belief is, let's combine best in class in the US, which is a low cost in situ recovery, low capital intensity, with high grade conventional projects in Canada that are so unusually high grade and truly seems to be God's gift to Canada. Really we stage these projects in a pipeline, and you've got staged production growth where to get uranium into the drum barrel. We lead the way with our US ISR production, fully built, fully permitted, ready to go, anchored by 2 of the largest processing plants in the US. And we follow that up with the development pipeline with over 100 million pounds of critical mass in Eastern Athabasca Basin. Rule of thumb in Canada, you need at least 100 million pounds in Athabasca on the east side to have critical mass to get into production. On the west side is probably more because there's no infrastructure. But we have the west side covered with our Shea Creek project. We have a partnership there with Francis Orano. And on the east side, we have a couple of joint ventures with Cameco and Denison. So I'll stop there and hand it back to you.
Great. Guys, that was wonderful synopsis of each company. I want to go into the market, the uranium market itself, but before that, I'd like to try and characterize the scope of the opportunity facing investors right now. We all remember, in fact, some of these companies were started back in the uranium mania or before the uranium mania of the late 2000s. But we remember that bull run. There was little, it's hard to find a parallel even in the junior mining sector for what happened back then. There were just a tremendous number of companies that were formed in a flash in response to the rise in uranium prices when it got up to 140 some odd dollars a pound. It was like mushrooms after a spring rain, and there were at one point well over 400 junior uranium plays out there, just scrambling for land and any kind of a scintillometer reading or whatever to put out a news release. And yet they all went up in price. The rising tide lifted all of those ships. The point being that there was a tremendous amount of generalist capital coming into the uranium sector from all around the world, that 400 some odd companies could all flourish and prosper and have their share prices and market caps rise in that kind of an environment. What we're looking at is a similar response, most likely in the uranium price, a similar kind of bull market in the commodity, but with only about a dozen, 15 or 20 uranium companies out there that are really worth looking at. So all of that capital that lifted 400 some odd companies at that point in time is now going to flow into the much smaller number of companies. So that's the kind of opportunity we're looking at. Of course, there will be more companies being sprouted out of thin air, but the companies that have survived to today, Jim, Jordan, Amir, your companies are the survivors, and you have had your pick and choose of all of the best projects over the intervening years. So you're going to be where the money's going to come, and it's going to be like my friend Doug Casey put it so well so many years ago, trying to deposit the contents of the Hoover Dam through a garden hose. Your market caps are going to have to explode higher when that money comes in. So that's the kind of opportunity we're looking at right now for the sector and for these 3 companies in particular. So let's look at the market. Let's look at supply demand. I mentioned in my opening remarks that we have a supply shortfall right now. And yet demand is still slowly but steadily rising and forecast to rise much more prominently, much more dramatically. So where does the supply come from right now? We kind of alluded to the fact that you want to be in a safer regime, but where is the supply coming from right now? Jim, you're up the top left of my screen. Why don't you go ahead and start off with that?
Yeah, I mean, there's sort of top 5 countries. Kazakhstan would be number 1, and we've just heard what's going on over there, so that I think is quite risky. Canada, Australia, certain parts of Africa, and if things get sort of moving up in prices, the US could turn back on. But in terms of what I would consider the safest place for supply, it would be North America from a jurisdictional perspective.
Yeah, and aren't we seeing some moves? Amir, you're really connected with U.S. Congress and politics as far as uranium supply. Aren't we seeing some moves to secure North American supply?
Yeah, absolutely. The stimulus, the infrastructure bill that came last year had provisions in it to really provide liquidity to the nuclear reactors. So our customers have to be financially healthy and viable to really then create a nice demand picture for us as the suppliers. Right now, the nuclear utilities in the US are in the best financial health they've ever been in. And they're getting license extensions beyond years they had projected. So these are not becoming licenses to print money, these nuclear reactors. You think about it, they've already operated. They thought they were going to operate for only 35 years, projected everything out that. Now they're getting a 20-year license extension, which they never anticipated. And beyond that, there's no capex. It's all sunk cost. And they're just generating electricity and the government supporting them because they're emission-free electricity. And that's what the government is prioritizing and rewarding. In addition to that, the Inflation Reduction Act pumped additional $4 billion into the topics we're discussing, but now towards the fuel end of it, right? Because great to have healthy nuclear reactors operating, but we got to be able to fuel them, get off of our Russian addiction problem. So that's now money going towards establishing, for the first time, a U.S. uranium strategic reserve. And a lot like the petroleum strategic reserve, make sure that the government can provide assurance supply, a short supply to utilities that may be caught, without sufficient resources, or get stuck with a shipment not leaving Russia on time, or other kind of disruptions. These are historical events. Like, I think what like anyone listening to this should realize is that in 2006 or 7, when we had a uranium bull market, these developments did not exist. The US government was in fact selling uranium back then. This is like, going back and looking at previous bull markets in uranium would be like watching the Canadian Football League, and we're about to watch the National Football League, like the US version of that. It's really a different value proposition. US government is on the bid, it used to be on the offer, right? And the governments have come to a complete conclusion that if we're going to decarbonize, like you said, Brien, while meet our growing energy needs, we must have nuclear in the mix. So more than anything, what's forming the policy decision-making in Washington and why it is bipartisan is because public opinion polls in the US for the first time are at an all-time high in favor of nuclear energy. That is what's underpinning the bipartisan support in Washington. So these are, again, unprecedented, and we never had this kind of backdrop in any of the prior bull markets for uranium.
Just real quick, if Mr. Adnani goes to Saskatchewan, he may or may not be welcome at the Grey Cup after his comments about the CFL. But the other thing is recently the U.S. government, Department of Defense, has started to make investments or look to invest in Canadian projects, critical minerals projects. So they're the sphere is now shifting, and they're saying, actually, North America is now domestic, not just America. So that bodes very well. And one thing on demand, when Amir was talking about those extensions, just imagine something like that's a Swiss watch that will consume between 400,000 and 500,000 pounds annually of U3O8 for 20 years without stopping ever. Most mines don't have that kind of consistency. So the demand side is so strong and growing, and the US is the biggest engine in the world right now for that consumption. It's pretty awesome. At the same time, supply is fragile.
Yeah, and our good friend Rick Rule puts it that his confidence in the uranium story is his confidence that when people flick a light switch, they want a light to come on, and it will absolutely be necessary going forward. Jordan is one of the explorers on our panel today. You're not focused so much on selling uranium right now, but you are focused on the situation in uranium, and what drives the price and therefore interest in your stock. You also have a great summation of the uranium story on your website, by the way. And one of the things I noticed on there is that the predictions for the supply shortfall as of a couple of years ago were pretty dramatic, but now those predictions are showing an ever greater. In other words, the gap is growing. It's not being solved by new supplies. Let's talk a little bit about the demand part of it. Now we know that demand is growing. We know that you know, the public perception of uranium and nuclear energy has improved, but we've got other factors coming in here. We have actual producers and developers like Amir building up stockpiles. We have the Sprott Physical Uranium Trust, which is an amazing catalyst for the uranium market right now. How is that altering the picture as we speak?
Yeah, well, look, the the supply side for this commodity, I say this often, the supply demand fundamentals, I truly believe, are the most compelling for uranium when you compare any other commodity. You've had a major supply side response that's played out over really what has been almost a decade, but in particular in the last 5 or 6 years, you've had supply discipline from producers, you've had curtailment, you've had depleting reserves and resources and production. So if you look at the supply side, we're now producing only about 130 to 140 million pounds primary mine supply. As we talked about, Kazakhstan accounts for about 40% of that. You add in Russia and Uzbekistan, you're looking at over 50% of primary mine supply coming from that block, which again, geopolitically right now, that's not great, and that's an issue for Western utilities that they're going to have to work through over the coming months and coming years, and they're going to have to be more dependent on Western suppliers. Demand side, it's interesting. I think the demand side is going to be what surprises people over the coming 10 to 20 years, and there's been lots of talk just in the last few years with some new demand coming on, in particular some of these advanced nuclear technologies and SMRs, so new nuclear power plant models and types. You've got about 190 to 200 million pounds of demand globally right now in reactor requirements. You have countries like China building 150 nuclear power plants in the next 15 years. It's 10 nuclear power plants coming on in one country. And if you look at what's the nuclear capacity that's been rolled out in the previous 35 years, that's more nuclear power generation coming on in one country than has come out globally in the last 35 years. You add in nuclear power plants being built in the Middle East, talking about parts of Africa, South America. Obviously, the largest consumer still remains the United States. But you now look at what's happening with some of these SMRs, the commercialization of these SMRs. And since we're talking about Canada right now, it's important to note that Canada generates well over 15% of its electricity from nuclear. Ontario's 60% nuclear. We do have the benefit of lots of hydro in other parts of the country. Otherwise, I think we'd see nuclear electricity generation constitute a much higher percentage in other provinces. But a few years ago, 4 provinces signed an MOU to help develop and commercialize small modular reactors, Saskatchewan being one of them, Ontario being another. Just a few weeks ago, a major announcement, the Canadian Infrastructure Bank announced that they would be loaning Ontario Power Generation almost $1 billion to build the first SMR at the Darlington plant in Ontario. So this could very well be the first commercialized SMR in the West at an existing nuclear facility. There's talks in the US of hundreds of these being rolled out. There's a number of companies, notable companies that are developing these, that are commercializing these. So this is, I think, going to be a very sneaky demand side story going forward, and it's going to surprise to the upside. It's growing right now at about 3% a year, but we could see that increase significantly. Key theme is electrification globally, and part and parcel with that, another key theme, as you pointed out, is decarbonization and clean energy. And again, these are 2 major themes globally right now that are underpinning this nuclear renaissance that we're seeing.
Yeah, the demand is growing and across the board. We've seen uranium or nuclear energy transformed from, as earlier this year or late last year, it was still a pariah industry, and now it's being regarded as a savior industry. If you look in Germany, their energy costs are far, far higher than they are in France, and they're about to freeze this coming winter and wondering where they're going to get power from, because they made the mistakes that France did not. So right over the border, they see that that example staring them in the face of what they should have done, and now they're moving to rectify that. So across the board, we have greater demand. Let's look at the market for uranium companies. You three are some of the best experts out there, obviously, for the M&A market, the capital markets for uranium companies, et cetera. Where does that look right now? We know that across the junior mining landscape, particularly in gold and silver and some of the other metals, it's gotten a bit tougher for companies to raise money. How is it in the uranium space? Perhaps we'll lead off with you, Amir. You're making all of the big acquisitions lately. I guess you have a better handle than just about anybody on this.
Sorry, how is it with respect? It's with respect to just other, like the sector?
How easy is it to raise money in the uranium sector? What's the interest from institutional investors? The uranium price is strong, I mean, but it's still hovering around $50. We haven't had a blow off move quite yet.
Yeah.
Is the interest there?
The interest has definitely improved. We had a long period where uranium prices were at less than $30 per pound. And this move to $50 definitely makes things, generates more interest, but nowhere near the kind of interest we're going to get when uranium prices move north of $75 per pound, or even towards $100 a pound, which is what on an inflation adjusted basis this should be to match the 2011 price. And when that happens, I think the interest is going to be truly multiples higher than where it is right now. And why? Because today, when you look at the uranium sector at $50, it still is a sector that struggles on a wide scale basis to generate free cash flow. At $50 uranium, we can't build new projects. This is very much analogous to lithium. When lithium prices truly took off significantly above incentive price levels is when you start to see that capital inflow into the sector. So the analysis that we've done, Brian, shows compared to lithium, uranium market right now, the combined size of funds that are owning uranium stocks right now is 1/10 the size of the total amount of capital earmarked right now to the lithium sector. And they both have to do with energy transition, but there's one big difference. At the current spot lithium price, lithium companies can build new mines and make money. At the current uranium price, this is still too low. No new mines are under construction, and companies are still not flush with cash flow. So the next leg up in the uranium price is not only in front of us, but I think will change the complexion of the market and enlarge it, very similar to lithium, at least by 10x in terms of total available capital. But for sure, 50 is better than $25 per pound. And for sure, there's more interest today than there was a few years ago.
Jim, your company, as uranium, you just happen to have a 40 million pound asset on your balance sheet as the uranium market started to perk up, which is an enviable position. So I know that you were approached by a number of sources for financing and money to advance that, which was already well advanced in the last cycle. What's your views on the market right now for money? Is it easy to get right now for uranium? And what, as far as the price of uranium, at what point do you think interest really perks up? At what point do a lot of these projects suddenly become viable? What price of uranium does that happen?
Well, I think the important distinction is that at any price, some projects don't become viable. They might get financed, but they don't really make sense. So you have to have a really good project in the right place in the world, the right kind of geology, logistics. There's a whole bunch of factors that go into it. So in the boom markets, really bad projects and bad management teams get funded. They don't really deserve it. But that doesn't matter, because when the price moves, so much capital flows to a very small market like ours that the prices of the companies in that space go bananas. And we're not there yet. Certainly, there's lots of interest to finance ValOre, absolutely. I think trading liquidity in ValOre is low, and I think at the last cycle it was absolutely maybe 10 times higher. So I think we've got some room to go. In 2009 and 10, when the price started gapping, it went from $40 US spot to 70, and the price was moving $5 a week. And what happened is it's a very kind of micro thing where all the institutional sales guys in Toronto or New York get in the phones and they start phoning all the hedge fund managers and saying, you've got to own uranium. And they say, well, which ones should I buy? And they say, well, there's only 10. There's only 15 companies. Just buy them all. And they do indiscriminately. So volumes go up, capital gets thrown at companies. We're not there yet, for sure. But it is actually a much more global market now too. So I think when that starts happening, it's just, people are going to be trading from Europe and Asia and Australia, Canadian listed or US listed stocks in Amir's case.
And just one note on that, from an exploration or earlier stage development standpoint, certainly the funding interest from investors has improved, but it's really coming from a rock bottom, right? As Amir pointed out, there's been a couple good years and there's been a lot of difficult years, and we've been around now for almost a decade, so we've seen these difficult years, and yes, things have improved, but I think there's still a lot of runway for a lot more money, a lot more interest to come in. You're starting to see institutional investors, take bigger stakes in companies and some of the ETFs and some of the physical holding companies as well, like SPUT, but it's a fraction of what I think can come in to the industry. And like you said, Brian, there's still this sentiment around nuclear that's improving, but I still think we're in the early innings of what will be a sustainable market. And then if getting back to Amir's point about price, $50 uranium, when you look at that in a historical context, I mean, you talk about 06, 07, price that went north of $135, $140 a pound. 2010, 2011 at $70 a pound. There's still a lot of room to move, and there still aren't that many companies, right? We've seen more companies come in. It's a part of our business, right? We, as a prospect generator, we look to partner up with companies that can raise money, that bring a strong geological backing to the table, and that can pay us cash in stock. So we do finance in the open market through private placements and other ways of raising money in the capital markets. But prospect generation has brought in millions of dollars in cash and stock as well. So it's a non-dilutive way for us to advance our project base without having to continuously go to the market.
Great points, Jordan. While we have you talking here, I think you're the best position to talk about some of the reasons why Canada leads in uranium exploration, or what the environment is there. That is the title of our webinar. After all, uranium exploration in Canada. I believe you have probably the most, or nearly the most, projects in Canada, and are dealing with the regulatory environment on a daily basis. How is it? How easy is it to work Canada generally, and the Athabasca Basin, and more particularly?
Guys, I'm going to jump up before Jordan goes, but Jordan, please continue. Brian, thank you. Jim, well done, guys.
Thanks, Amir.
Thanks, Amir. We'll see you.
See you.
Thank you very much.
Yeah, look, we've talked about the point that the basin is the highest grade depository of uranium in the world. It's 10 to 20 times the global average. So when you're looking at the value per ton of these high grade uranium deposits, they're really unparalleled. In fact, the highest grade zones of mineralization, some of these deposits represent the richest types of mineral deposits you can find of any commodity anywhere in the world. So that's what makes it so interesting for investors, and that's what really is the basis for the incredibly high return potential and value proposition for investors that get exposure to a high grade basin discovery. And really at Skyharbour, what we tried to do is become a one-stop shop for high-grade uranium exploration and discovery potential across a diversified project portfolio in the basin, with multiple operators and multiple companies paying for the lion's share of that drilling and exploration, as I pointed out, through the prospect generator business. So you've got the high grade nature of these deposits. It's really a geological anomaly in the Athabasca Basin. But then you've also got Saskatchewan consistently ranked in the top 5 mining districts and jurisdictions by the Fraser Institute. So it really is, from a regulatory standpoint, permitting standpoint, geological standpoint, government relations standpoint, it is, again, one of the best places in the world to work. So you can, basically check off all of these boxes when you're going in and you're carrying out exploration or development work in the basin. It's a geological anomaly. It's the best in the world. There's a long history of mining there, many decades. So there's a skilled workforce. And so it really is it, as far as I'm concerned, certainly in the world, as being one of the top districts to go in and work, raising capital and deploying that capital. But you look at where Jim's project is in the north as well. It's interesting. You see a project like that compared to pretty much any other deposit globally is incredibly high grade, right? And it's, the basin obviously is higher grade, but it just shows you in Canada, we are lucky that we have this endowment of high grade uranium in some of the best mining districts in the world. And that's been, a big issue, is this cheap abundance of supply coming from Kazakhstan, coming from other parts of the world. That's been one of the reasons you've seen an oversupplied market, which is now transitioned into a market that's severely undersupplied, in particular in the West. But these cheap pounds that have come from Kazakhstan and other parts of the developing world and in the East, there is a solution here for Western utilities. It is Canada. And I think that's where companies like ours stand to benefit. I think that's a big reason you saw Amir make the moves he did into the Athabasca Basin. And I do think there's going to be, getting back to your question, Brian, about deal flow, in addition to obviously a nascent financing market that is we're seeing more and more money come in, but again, still a long way to go. I think, and you've seen it just even in the last few days, there is going to be a lot more M&A and deal flow, corporate transactions taking place over the next 12 to 24 months.
Great. And we're going to get back to a little bit of that in just a second, Jordan, as we get into questions and answers. And I'd like to remind our viewers that we do have a Q&A session to end this webinar. So please submit your questions. We have a bunch of good ones coming in, I see. So probably have more questions than time, but please send your questions in, and we'll try to address some of the ones that have the most appeal to everyone here. Let's get into each company's, both of your companies' upcoming catalysts very quickly. What should investors look at in the near term as a potential catalyst to the share price or company value, not just long term, but more particularly in the near term? Jim, let's start off with you.
Yeah, all the drilling at Angelac, so RC drilling and core drilling. We actually had a news release today, the very first batch. So we drilled all year, and this is the very first time we received assays was today. And for the next 6 to 8 weeks, we expect more batches. So we drilled 3 zones with our RC rig and 2 zones with the core rig. And so in addition to, or aside from the results today, all the rest of the assays are coming, which is great. And then of course we have the project in Brazil. So we have assays coming out from auger drilling, trenching, rock sampling, soil sampling. So lots of exploration news to come.
Great. And Jordan, let's get to your catalyst, but I'm going to address a question. I think it'll fit your response. So we'll knock this question off as you comment on the catalyst. Someone's asking, I know in the next year, Skyharbour will be starting their largest drill campaign ever. Confirm if this is fully funded, and also how will it break down in terms of meters at Moore and Russell Lake, any known high-grade areas you are targeting?
A great question.
Yeah, no, that segues in nicely. So as I mentioned, this upcoming 12 months will be the busiest, most active drill campaign, 12-month season, if you will, that we've ever carried out collectively with our partner companies. So we've got 10,000 meters that we're fully funded for over 2 projects, our core projects. Most of that drilling, say about 8,000 to 9,000 meters, at least the current plan is for 8,000 to 9,000 meters, will be at Russell Lake, which is the recently optioned project from Rio Tinto. And then we'll do a little bit more drilling in the winter at Moore Lake. Moore Lake, for investors that have been following the story, know it's been a flagship project of ours. Advanced stage exploration assets with grades as high as 21%, U3O8 over 1.5 meters. So host to high grade zones at what's called the Maverick Corridor. It's been very interesting. We've been drilling a little bit deeper into the basement rocks at Moore Lake more recently, having success there. So we'd like to continue with that with a little bit of drilling in the new year. But Russell Lake, as we're earning in an initial 51%, that's where the bulk of the exploration budget and meters are going to go. And we have spent the last several months since closing the transaction going through all the historical data. There's been a fair bit of historical drilling and exploration. There's high-grade uranium, multi-percent in several drill holes. As I mentioned earlier, it's a very strategically located advanced stage exploration asset, road accessible, power lines, and an exploration camp that we're going to stage out of it. Also should bring our drilling costs down at Moore Lake because we can access more from the camp at Russell. So we're going to be commencing that drilling here soon. We've got targets that we've selected, that we've refined based off of the historical work. And we've done a whole bunch of new data compilation and reinterpretation, new geological modeling. Got to remember, the previous operator here for the last 10 years has been Rio Tinto. Rio Tinto is a big company, obviously one of the largest diversified mining companies in the world, and they're now a large shareholder of Skyharbour, so part of this transaction. But they were also carrying out, as I like to say, big company exploration, and we think there are areas and targets on that project that remain to be fully tested and explored, and we think we can go in there and in a relatively short time frame deliver a new high-grade discovery at that project. So that's the drilling that we're going to be carrying out over the next 10 to 12 months and fully funded for that 10,000 meters. We've also got now 6 active partner companies of the 7 total, and these companies are going to be, most of them will be funding pretty significant exploration and drill programs at these various projects over the next 12 months. We have the expectation that we'll see probably, as I said, about another, I would say 25 to maybe even 30,000 meters across several programs and projects, again, funded by these various partner companies. So this is a major combined drill campaign for Skyharbour over the next 12 months when we couple our main projects with our partner funded projects.
Sounds great. Drill results are the best catalysts of all for a junior mining company. And as we've seen in previous discovery plays, the power of high-grade targets and discoveries in the Athabasca Basin can be transformational for a junior company. So you've got a number of those and a lot of meters targeting them in the coming weeks. So that's wonderful. It looks like we're sliding into our Q&A here, because my question for Jim just got said much better by one of our viewers. Can Jim provide an update on the strategic review process of ValOre and plans for 2023? I was going to say, Jim, that the way I look at it, your market cap would support either one of the 2 companies within the one company that you have, or 2 focuses that you have there. Tremendous value that can be unlocked. Can you give us I know you can't talk a lot about it, but maybe give us some general idea of approaches, ideas, thoughts, perhaps timing?
Yeah, the whole background is that we acquired the palladium asset at a time when the uranium asset had very little value. We kept it on care and maintenance and kept it in good standing. And then that's really switched. About 2 years ago, the uranium market started getting a lot hotter. And so we went from not talking about the uranium asset very much to it really being at the forefront and very valuable within the company. We did raise some money last year at the end of 2021, and we had a pretty substantial exploration program at Angelac, the uranium project, this year. So we started the strategic review because we were really not getting credit for either project because it confused investors. Were we fish or fowl? Nobody knew or understood it. And so basically both projects were punished. We started a process with Canaccord. They communicated with a whole bunch of people in the uranium sector and also gold producers or precious metals producers, mostly focusing on Latin America to see what the interest level might be in Brazil for Pedra Branca. And we've kind of moved that along really nicely. We're focusing it right down onto very interested parties. And there's interest in both projects. And we're just doing the dance, really. I can't really say anything more than that. And I think there's interest in the people that we're talking to. We really like and would like to do business with them. And there's just a few groups, and we need to sort out what our next steps would be. But we've got lots of options, and one might be just to spin out the palladium asset into its own vehicle, or we could sell it.
Yeah, and that's another great catalyst. You a 2-for-1 opportunity for investors. So it is something that's out there, and you know, no real sense of timing on that, but we know it shouldn't be a really long-term event either.
Well, the bankers won't get paid until the deal gets done, so there is a sense of urgency.
There you go. There you go. Okay, on our looking over some of our questions, can someone please comment on any bottlenecks or geopolitical issues between the uranium producers and utilities, conversion of mined uranium to fuel rods? Any issues there that you can see, or I don't know if that's a real compelling investment.
I think from mine to conversion, there could be, depending upon where the deposits are in the world. And I think that, you have to think about what the profile of the Russian nuclear business actually is. It's not like they're just worrying about their own reactors. The Russians built their practice on actually going global with their expertise. And so they're helping other countries build reactors and providing all of the nuclear science and the building expertise behind putting these into production. So they need to secure uranium, U3O8, and converted and enriched uranium from their clients, for their clients, on behalf of their clients all around the world. So deposits are incredibly valuable to them, and that jurisdictional risk is pretty starkly contrasted against the US, which has almost 100 reactors, the biggest engine in the world for consumption, and they don't want to give up the deposits either. So there could be bottlenecks with any kind of conflict happening right now, and it's obviously escalating.
Yeah, and just a quick note on that. We have seen some news more recently. Some issues, material getting out of Kazakhstan over to the west. As you probably know, there's a number of joint venture producing assets in Kazakhstan with Orano, with Cameco, and most of that has flowed through the port of St. Petersburg, going through Russia. Obviously problematic currently, but they're looking at a secondary route, the Trans-Caspian route, and the word is there's issues there. May not be a very pragmatic and realizable route going forward. You saw Cameco announce just a few weeks ago or last week a new contract with the Chinese. So I think this ties in with the market bifurcation, right? Where you've got, in particular with conversion and enrichment, Russia's had a stranglehold on those parts of the fuel cycle for many, many years. And so it's not just the primary mine supply that you need to take into consideration, it's the whole fuel cycle. And again, this geopolitical unrest that we're seeing currently, it's going to have major ramifications for the entire fuel cycle. And the West is really going to have to get its ducks in a line here going forward to ensure that the largest consumer currently being the U.S. with over 90 reactors, and Western Europe is still a very large consumer of uranium for their nuclear power plants. These facilities need a reliable, safe source of uranium going forward, and various other fuel products, intermediate fuel products, and we're not going to be as we're not going to be able to rely on Russia and potentially other ex-Soviet states. And so it's creating a very interesting dynamic. Again, I think as Western uranium companies, I don't know if the market is quite priced in, the consequences of what's happening right now. I think there's still a premium value that needs to be priced in, or that should be priced, that will be priced in, hopefully, as this all unfolds globally.
I want to jump in when you're saying that, like, he's painting a picture that is so healthy for demand for projects like we have. And when I first went to China, it was over 10 years ago now. I think there were 17 reactors. Now there's over 50. And I think the Western world has been asleep at the wheel. But right now it's obviously waking up. And a reactor costs over $10 billion to build and must be supplied. And you can't just turn it off if you don't have supply, if you don't have fuel. So you've got almost 100 reactors in North America that need to consume, and the Chinese now have over 50, and they're going to 100 quick. And Jordan was talking about some of the proposed plans. Russians are doing the same. So these deposits in places in North America will become quite a bit more valuable. That's what we're counting on.
Well, yeah, great point. Demand is steady and growing. Supply is fragile, and it's all coming to a head. Well, we are coming to the end of our time allotment, a little bit over right now, so I'm going to give you each 1 minute to give us kind of a speed summation of why uranium, why now, and why your company. Jordan, why don't we start off with you?
Yeah, sure. So, as I talked about earlier, I truly believe that this commodity has the most compelling underlying fundamentals driving it. You have three major global macro trends right now that are underpinning this nuclear resurgence: electrification, decarbonization, and clean energy, and then energy security and independence. We're seeing this market bifurcate east versus west. We're going to need the West to really step up its production, development and production going forward. At Skyharbour, we're well positioned to take advantage of this as one of the larger now juniors in the basin. As I said, really a one-stop shop for high-grade uranium exploration and discovery potential across a number of projects. We do have a number of projects with resources, as well as other projects that are earlier stage that offer that blue sky discovery potential. We have a number of strategic partners, including Rio, Denison, and Orano at the Preston project. And we have our busiest, most active year coming up in terms of news flow with the drilling and potential new option and JV partners coming in at some of our other 100% owned projects that we haven't yet farmed out.
Great, Jim.
Well, ValOre holds Anglac, the LAC 50 inferred resource. It's one of only 6 held by independent Canadian listed companies. We're completely undervalued versus our peers. We have a high quality project. High quality would be defined as near surface, high grade, excellent metallurgy, and significant growth potential. And all of that wrapped into a Canadian listed company that could become very liquid as the policies globally are pushing people towards nuclear. Demand is pushing and supply is fragile.
Great summation, guys. Well, I will close it out with just a couple of notes. I think our panelists today have done a wonderful job of summing it all up, but I can speak again from experience that you have not seen anything like the power of a uranium bull market when it does kick in. And I started this off by saying the uranium story was inevitable. Now it might be imminent, but I think you've also seen that it's also irreversible at this point. The demand trends are there. The supply has not met up with demand, and so the price must go up. And when it does, we're going to see the kind of money come into the sector that will be focused, laser focused on just a few companies. The kind of money that created a bull market for hundreds of companies in the 2007 timeframe. will now be focused on a precious few. And I think the three companies today on this webinar, Skyharbour, ValOre, and UEC, are three of the best. They will be at the top of the purchase list when this happens. And again, this is going to happen. So prepare yourselves accordingly. And thank you all my panelists for joining us. Thank you all our attendees for attending this session. We hope to do more of these in the future. So give us some feedback. Let us know how it went. Thank you so much.
Thanks, Jordan.
Thank
Thanks,
you.
Brian.